Shadow banking does not announce itself. It does not arrive with a nameplate. It does not operate under a single institution. It does not submit to a single law. It exists as a system of activities that look familiar, that feel legitimate, that move enormous amounts of capital. And yet, they do so without entering traditional regulatory space. This briefing examines how shadow banking escapes global regulation and why repeated attempts to control it consistently fail. Traditional banking is regulated because it is visible. Banks take deposits, they make loans, they hold licenses, they report balance sheets. They operate under explicit supervisory authority. Shadow banking performs many of the same functions, but without those labels, it provides credit, it creates liquidity, it transfers risk, it amplifies leverage. It simply does so through structures that fall outside the legal definition of a bank. This distinction is critical because regulation begins with classification. What is a bank and what is not? Shadow banking thrives in the space between those definitions. When regulation tightens in one category, activity migrates to another, not through illegal avoidance, but through structural adaptation. This is regulatory arbitrage, and it is legal by design. The shadow banking system includes money market funds, hedge funds, private equity and private credit vehicles, securitization platforms, repurchase agreement markets, special purpose entities, structured investment vehicles. Individually, each appears manageable. Each has a regulatory framework. Each files reports. Each claims compliance. Collectively, they form a parallel financial system, one that replicates core banking functions, without triggering core banking oversight. This parallel system is global, and global regulation faces an immediate barrier: jurisdiction. Financial activity does not remain within national borders. Capital flows across markets instantly. Shadow banking exploits differences in national rules. When constraints increase in one jurisdiction, activity shifts to another. When disclosure is required in one market, transactions reroute through another. Oversight fragments across borders that do not coordinate effectively. No single regulator sees the full picture. Non-bank institutions sit at the center of this system. They do not take deposits, so they avoid banking regulation, but they provide leverage. They engage in maturity transformation. They create liquidity through short-term funding. These functions generate systemic risk without triggering traditional controls. Liquidity is the lifeblood of shadow banking. Short-term funding supports long-term assets. Overnight repurchase agreements, commercial paper, short-term instruments funding illiquid positions. This mismatch creates vulnerability. But because funding sources are diverse, layered, and opaque, risk is difficult to measure. Balance sheets do not tell the full story. Exposure is embedded across entities. By the time stress appears, it is already spread. Central banks understand this risk, but their tools are designed for banks. They regulate institutions, not processes. When crises emerge, support often extends indirectly to shadow institutions. Liquidity facilities expand. Asset purchases stabilize markets. Collateral rules are relaxed. The goal is stability, but the effect is moral hazard. Shadow institutions receive support without formal oversight. Risk-taking is backstopped. but not governed. Financial innovation accelerates this cycle. New instruments emerge faster than regulation can adapt. Securitization transforms loans into tradable assets. Derivatives transfer exposure without transferring ownership. Synthetic structures replicate risk without touching balance sheets. Leverage hides inside complexity. Each innovation appears incremental. Collectively, they transform the system. Transparency initiatives attempt to respond. Reporting requirements expand. Stress tests multiply. Data collection increases. Yet the data remains incomplete. Shadow banking adapts by increasing complexity. Structures fragment. Entities multiply. Transactions layer. Complexity overwhelms supervision. Offshore jurisdictions amplify this effect. Shadow banking entities incorporate where disclosure is minimal. Transactions route through legal entities designed to obscure concentration. Risk is distributed across shells, funds, and vehicles. Global regulators see fragments. They do not see systems. The result is a paradox. Regulation increases. Compliance costs rise. Rules multiply. Yet systemic risk does not decline. It migrates. Shadow banking does not resist regulation. It absorbs it and reroutes activity around it. This system persists because it serves powerful interests. It provides flexibility. It enables leverage. It supports asset prices. It supplies liquidity when traditional banks pull back. And it allows capital to operate beyond democratic control. Shadow banking expands most rapidly after regulation tightens elsewhere. When banks are constrained, non-banks fill the gap. Credit continues. Risk accumulates elsewhere. In earlier briefings, we examined offshore systems protecting elite capital. Shadow banking intersects directly with those structures. Offshore vehicles host non-bank activity. Capital protection and regulatory escape reinforce one another. Jurisdictional opacity meets financial complexity. States tolerate this system, not because they are unaware, but because constraining it would carry costs. Liquidity would contract, asset prices would adjust. Market volatility would rise. Political consequences would follow. Incremental oversight is safer than structural reform. Crises briefly expose the system. Liquidity freezes. Markets seize. Interventions follow. After each shock, reforms are proposed. Some rules tighten, others loosen. Activity shifts. The core architecture remains intact. Shadow banking escapes regulation not because regulators fail, but because the system is designed to evolve faster than control. Regulation targets institutions. Shadow banking is a process. It is not defined by where money sits, but by how it moves. Understanding this distinction is essential, because modern finance is governed by flow, and flow is harder to regulate than location. As long as capital can migrate across instruments, jurisdictions, and entities, shadow banking will persist. It will adapt, it will expand, and it will continue to shape global outcomes, quietly, systematically, invisibly. Analysis complete. In the next restricted briefing, we will examine the financial architecture behind permanent debt and how leverage becomes policy. Subscribe to Dark Power Index to access the next restricted briefing file. Access the data.